Hello sector watchers, welcome to the show. This is episode 104 of Sector Spotlight. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. If you'd like to stay in touch, please use any of the handles on the screen. Today my plan is to talk you through the current rotations of a number of asset classes and the sectors. Combine the current daily rotations with the longer term weekly rotations, see if we can get a handle on that. That'll probably take up the first half of the show. And after that, I also want to look at sectors, but bring in small cap sectors as well as equal weight sectors and combine that with the subdivision, the breakdown is a better word, of sectors in offensive, defensive and sensitive. We talked about it in a previous show and I wrote a blog article about it. So I did a little bit more work, I played around with them. I've set up RRGs for offensive, defensive and sensitive, and I did that for all three. And I'm hoping that we can see or can find a general direction, or maybe find the anomalies, find where things are not aligning. So that's the plan for the second half of the show. So again, probably a very full program. I have no idea how long time I'm going to spend in the second half. So let's get started with an overview of the current rotations in asset classes and sectors. What happened in asset classes? On the right hand side of the screen we have the RRG showing the daily rotation for a number of asset class ETFs, and on the left hand side we have the weekly version of that universe. We quickly rank the universe on performance, and we see that the stock market did really nice last week, up 2.3%. And it is immediately the only outperformer in this universe, while the benchmark VBINX was up 1.6%, meaning that every other asset class in this universe was below the benchmark. This is what I call an extended universe, because the benchmark only includes ITOT and the fixed income groups, so corporate bonds, high yield and government bonds, and the US dollar, i.e. cash, and commodities as well as real estate are not inside the universe, inside the benchmark. So what have we seen? We saw a strong performance, but the momentum of the stock market, so it was a strong move already, but over the last 5 days that momentum, that relative momentum versus the benchmark came down, while for the fixed income cluster it came up. However, the stock market ITOT is still way ahead to the right hand side of the graph, which is a positive, and the fixed income clusters are on the left hand side of the graph, which is more negative. So this is a momentum based move. They're basically only moving on the vertical axis. Very clearly a negative rotation short term for both commodity ETFs, so DJP and GSG now moving from weakening into lagging, and we see V&Q real estate moving from leading into weakening. Now how does that compare, how does that line up with the weekly RRG? If we start with the stock market, then we can see that the tail for ITOT here on the weekly RRG is now definitely curling back up and moving back towards the leading quadrant. And that's good news. It's good news for stocks, because what it means is that the stock market versus VBINX, or versus the cluster of fixed income asset classes, seems to have ended its rotation of losing relative strength, losing value versus the benchmark, i.e. versus the cluster of fixed income asset classes. It's now picking up, so it's starting a new leg in an already rising relative trend of stocks over bonds. And obviously the same goes in the reverse for government bonds, which are now very clearly moving from improving back to lagging, and we see a similar rotation for high yield, albeit a little bit later, so it's following government bonds. And then we have corporate bonds, which are already inside the lagging quadrant, and you see those tails nicely rotating inside, improving, and then rolling back down towards the lagging quadrant. So and then we have, of course, the both commodities, DJP and GSG, still very strong, but you can see that here at the end, that tail is starting to level off and to roll off and lose a little bit of relative momentum, and that's what we see here in that daily RRG, where both tails are now inside lagging. But you can see that on the weekly, these are still, I was going to say by a mile, but very clearly the strongest asset class, and they have plenty of room to go through a correction from leading, maybe into weakening, and then back up. We'll have to see how that works out, but commodities definitely a commodity class to hold in any asset allocation portfolio. Most important move for the time being, ITOT rotating back up, government bonds and the other fixed income asset classes rolling over back down. Now, we go and look at a few individual charts, then I think the one that we need to look at least the one that we need to look at, is ITOT. As it's now back in swing, back in full swing, I was going to say, because it broke above its former high. We've seen that 2 weeks ago, and it is still continuing. Obviously, with the steep rise, the risk of a setback is increasing, but because of the break to new highs, we have solid support at the previous high, and that rhythm of higher highs and higher lows has re-established itself, and that looks good for stocks. Also, if you look at the relative strength versus VBINX, that has pushed to new highs, and you can see that the red RS ratio line looks to be bottoming way above the 100 level, and that's what you see here in the RRG, that the ITOT tail is rolling back up, rotating back up towards the leading quadrant, and the crossover will happen when the green JDK RS momentum line will cross above 100. Now, which other charts are worth looking at here at an asset allocation level? I think if we talk about the broader stock market, what I like is that the new 52-week highs, we've monitored that chart for a while, and while it was going down, and it now seems to be putting in a low. You see that the moving average, that is a 12-week moving average, so about a quarter, 12, 13 weeks, has started to curl back up, and the raw value is actually up to 549, which is, getting back to nice numbers that are corresponding with the uptrend. So that little dip here was preluded by the declining new highs, and now it's picking up, and it's confirming the current strength of the market, I think. If you look at the dollar index, always interesting to see. We're still holding up very nicely and very well above that double bottom breakout. We ran into a little bit of trouble. I should have extended this horizontal resistance level, so I'll use my cursor for that. That's 94.83, let's say around 95. That is now a resistance level above the current price of the US dollar. I think the bottom still looks good. I think it's still working its way higher out of that low, and especially when we break 95, that'll be renewed fuel for a further rally. As you know, that is better seen on the price chart of the euro dollar, and you can see somewhat similar, and then the corresponding level of euro dollar would be a break below 115 in the euro dollar price. And you can see that the rhythm of lower highs and lower lows is intact. It'll be confirmed once we break below 115, and that head and shoulders pattern is now in full swing, which means that we can peg a price target still around the 111, 110.50 area for the US dollar. So that's US dollar strength. When this is going down, that means that the dollar is getting stronger. So a quick look at the government bond chart. That is, it broke a little bit higher. I think we could safely draw a line here, which is resistance around 2670. Maybe putting in a new high here. We don't know yet. What we do need to monitor is definitely this high here. That's around 27, and the recent low around 26.25. A break above 27 means that the downtrend has ended. If we break below 26.25 and preferably below 26, then that downtrend gets new fuel, gets a new trigger, and that means that it's gonna push yields higher. So we'll have to see how that works out. But that's the story for now. That's how the things look for the time being. The relationship between stocks and bonds, obviously with a strong chart for stocks and a somewhat weaker chart for bonds, that ratio has now rallied further. You can see that the negative divergence that we were monitoring for a couple of months, that's now gone. That has been negated, and the price is actually breaking out of its already rising channel, which is good news and usually means an acceleration. So I'm still sticking or going back. Well, I was going back for that already a couple of weeks ago, with a preference for stocks over bonds. And that's also what the RRG is telling you. You see the tail of ITOT curling back up and the tail of GOVT rolling back down. That's a very clear preference for stocks over bonds. I'm going to leave it at that for asset classes, and now we're going to switch to the sectors. And then the sectors. On the right hand side, the daily RRG for sectors, and on the left hand side, the weekly equivalent. I've added one more day, so it's 6 trading days, because the market has just closed, so both charts now include today, which is Monday the 8th, data. And let's have a look at the performance, and we see that materials actually did very well with 4.5%, technology, discretionary 4 and 3.5%, and then we have energy industrials 2.3, 2.2, just above the benchmark, the S&P, which came in about 2.1%, and everything else is below the benchmark, starting with stables and then all the way down to healthcare and utilities, which actually financials also put in a negative week. Financials, let's say, unchanged. Healthcare sort of unchanged, but utilities definitely lost. Lost 1% of its value. If we look at the rotations, then we see an interesting move for technology, which started the week not that well, but then in the second half of the week started to move at a positive RRG heading again, pushing further into the leading quadrant. Technology had a very good week, but rolled over today. That's actually today, so this is Friday. Everything looked good, and then today you see discretionary rolling over downward. We see healthcare rolling over inside the improving quadrant. That's a negative. We see staples in a vertical move. That's pretty much only momentum based, so it's picking up a little bit of momentum, but not much in relative strength. And today's move actually seems to be moving left again, so that's lower on the RS ratio scale, which is a negative. And then we have utilities, industrials, financials, all pushing further into the lagging quadrant. Real estate, very close to the benchmark, but moving at a negative heading. And we see energy moving into lagging, but already starting to pick up a little bit of relative momentum, but it's at very low levels. It's the lowest level in terms of relative momentum. And we see communication services hooking back up. But again, it's the lowest reading on the RS ratio scale. So for that shorter term trend, communication services is still not looking that good. If we move to the weekly version of the RRG, then we see pretty much the rotations continuing that have been building up over the last few weeks, and which we have discussed here in Sector Spotlight a few times. And if you look at this RRG, you can see that there is actually a pretty distinct move. You know, the sectors go sort of either at a strong heading, so moving towards the top right, or they're moving towards the bottom left. So there you see, like, you know, here discretionary, moving almost in a straight line from bottom left to top right, and you see communication services and healthcare and utilities moving from top right to bottom left. And that's what I want to discuss a little bit more later on after the break. But you know, the clear distinction of those rotations is very clear. I mean, we've had shows where we discussed that sectors were all over the place, and you saw, you know, big curls on the tails, a lot of bands, a lot of curves being made, and now you see very little curves. They're very long, almost straight lines, and that means that the move is powerful, that there is a very clear direction, relative direction, I have to say, for these sectors. A few are changing. Financials, if we highlight that, then where's financials? Here's financials. You can see that that is a sort of a zigzag move. We have technology, which seems to be curling back up. And then we have materials. That's right there. You see, that's, you know, zigzagging a little bit, but in essence moving in the right direction. And we have got industrials, which is almost at the same spot, but also a straight line. I don't know if you noticed, but the sectors that I just highlighted as not being a straight line, they have very short tails. So materials, industrials, technology, financials, and to a lesser extent staples have very short tails. The other ones have very long tails, so that means that there is a lot of power behind those moves. And I think that that's the most important message that we can get from the RRG right now, is that there is a clear distinction between strong movers and weak movers, or a strong direction and a weak direction, sectors that are very strong and sectors that are very weak. And I would like to dive into that a little bit deeper after the break. So stay tuned, and we're going to talk a little bit more about sectors and then bring in small caps and equal weight sectors, because they have a story to tell of their own. Okay, let's continue our discussion on sectors and extend it a little bit. As you may know or may not know, I've been talking here in the show and writing in my blog about the fact that especially the defensive sectors were very clearly rotating into the lagging quadrant and underperforming the S&P 500. And following the general assumption, knowledge, that when these defensive sectors underperform, that usually happens when the market is strong. That's the base assumption that we're working from. And for those of you who are following the show a little bit longer, you know that I used to use a two-tier or two-level distinction between offensive and defensive. There was no choice. It was either offensive or defensive. That's a breakdown that's used by MSCI and S&P. And I stumbled upon a breakdown by Morningstar, actually alerted by one of you guys, that breaks it down into three. So they have offensive, defensive, and sensitive sectors. And to me, that makes more sense. You know, looking at a lot of charts and looking at a lot of these sector rotations, that just seems to make a lot more sense. So I spent the better part of today, and actually started with it last week, to sort of rearrange my lists and my my RRGs. And also followed by, or as a result of a video that I did for Chart School on chart lists. I don't think it's already published on YouTube, but it will be there soon. And so basically that forced me to update my chart lists, and now I've forced myself to update my RRGs. Now here's the basic one. This is what we've been talking about before the break. And I actually created a breakdown of defense. So here, this is the large sectors. This is the RRG that we've been looking at. These are the sectors. We usually also look at the ETFs. And then we have the equal weight sectors. We talked about these in the show before, and I wrote about it. Very often quite similar rotations, sometimes a divergence, an anomaly, and those are the moments where you can actually get some extra information from comparing the equal weight RRG with the cap weighted RRG. And then we also have the small cap sector RRG. And again, very often sort of a similar rotation, similar movement, but when it diverges from what we see in the spider ETFs, we can find some additional information. So with these three ETFs, we can get a big picture on what's happening at a sector level, from large to small and also equal weight. Now, I wanted to combine that with the offensive, defensive, sensitive breakdown. So what I did is actually set up RRGs for all three these universes, breaking them down in offensive, defensive, and sensitive. So if here we have large cyclical. So these are the large cap cyclical sectors. And you can see that discretionary, obviously very powerful. Financials, in general, still powerful. Last week and a half, losing a little bit. Materials, definitely picking up. Nice long tail, increasing. And then we have real estate, which is the odd one out. We can also look at the equal weight cyclical. So these are the same sectors, but now on an equal weight basis. And you see it's different, but the general picture is the same. You got discretionary. In the large cap, it was way inside leading. Here it is in improving, but powering towards the leading quadrant. Financials, equal weight are further into leading, but they're also losing a little bit of relative momentum. Here we have the materials, and that is in the equal weight is just turning around, so it's just starting to pick up. And then we have real estate, which is also in weakening, but a little bit further to the right. And then finally, we have the small cap cyclical. So it's the third version. And then you see that there are a few differences, because here materials is actually super negative. It's rotating into the lagging quadrant. And we have consumer discretionary. Remember, in large and equal, it was large cap was in leading, equal weight it's in improving. So small caps, it's actually in lagging, but it's starting to improve a little bit. And then we have real estate small caps. Those are inside weakening and moving towards towards lagging, but they're not there yet. So now we've had the three RRGs for the cyclical sectors. And we can do the same with the large cap defensive. And here is the story that I told. These defensive sectors are powering into the lagging quadrant at long tails. So that is a very clear negative rotation for defensive sectors. And if we look at the equal weight defensive sectors, you get a similar picture. These are all at a negative heading. You got the consumer staples here. It picked up basically today, but it's very low. It's very short tail, so it's a very stable relative downtrend. And then we have the small cap defensive sectors. And here you see one odd one out. That's consumer staples in small cap is actually picking up a little bit. Still on the left-hand side, but it's picking up. So we can get a more granular view of what's going on in the various sectors broken down by offensive, defensive, and sensitive. And sensitive is the last one that we're going to look at. So we've got large cap sensitive. And you can see it's a little bit more spread out. We have obviously got energy nicely rotating there. Technology is on the right hand side. It went through a negative rotation, but as you can see, it's this week, today, it's starting to pick up a little bit. Communication services definitely a negative, and industrials picking up a little bit, starting to move in the right heading. So a bit more of a mixed picture, but I dare to say that it's biased toward positive. Really, the only one really negative here is communication services. Now let's see how that goes into equal weight sensitive. You see the dominance of the move of the energy. So this is a really big move. Look at how small these tails are compared to energy. So if we bring that there, and maybe we should even take energy off and fit it. And then you can see how this one is moving, and then we bring energy back and it's way up there. So these are the equal weight sensitives, and they're also, I'd say they're neutral to positive, probably leaning a little bit more to positive with the exception of the communication services sector. And we can do the same for the small cap sensitives. And you see a sort of similar picture. And the keen observer may know that there's only 3 here in this group. And that's because there's no small cap ETF, small cap sector for communication services. That's included in technology. And here you see technology, communication service on the right hand side, rotating in here. You see that the distances are getting smaller, and you see here industrials very close to the benchmark, and energy powering there. So they're all on the right hand side. So in general, these are also pretty good, I would say. Now we can bring all of that together, and that's what I did, and I have to wrap it up. I'm going to do more of this in the future because I think it's an interesting approach. And what I did is I wrapped it up in a table. And here you see my take on all these sectors from large to equal weight to small. And you can see where the pluses and the minuses are. And then to bring all of this together into a big picture view, you got to look into the table here on top, and you can see that across all sector breakdowns, large, equal weight, small, cyclicals are predominantly positive. Defensives are predominantly negative, and the sensitive sectors, I think the balance is shifting to a positive. And with that, I think that the overall image for sector rotation is pointing to a stronger move for the S&P 500 in coming weeks. And that was it. That wraps up Sector Spotlight for this week. Ladies and gentlemen, thank you for watching. I hope you enjoyed the show. If you did, you know what to do. If you've got anything to share, any feedback for us, please let us know on any of the channels on the screen. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. And I hope to see you again next week, same time, same place, here on StockCharts Television.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.